Hey guys, how's everybody doing? Thanks for joining the channel. My name is Max. You guys know that. I got my Coke. I got my dog. I should say I have my Coke. I have my dog. But anyway. All right. Let's see what the market's doing, huh? It's bouncing a little bit. Afternoon show of the trade of the day was, remember, buying the dip. Maybe that'll work out. None of my live show trades have been working out, but hopefully the one yesterday popping right back into this area where there's been buyers before a couple of times, taking a chance and seeing maybe if there's buyers there again. So far, anyway, the buyers have been there. We'll see how much progress they make. They haven't made too much progress yet. We'll see. We shall see. Could just grind here the rest of the week. Look at Q's. All right, same thing. Q's went into the same area, and they're also bouncing in the same manner. Okay, so that's great. Bitcoin's up a half point. But in the bigger picture, Bitcoin is balancing a 104. Last week they had two balance areas of like 109 and 108. Anyway, they fell out of that balance, and now they're down here balanced out at 104. Lately, 103 has been too low, 105 has been too high, and they've been going back and forth in that area. 10 years, 4.359. That's good. It's down this morning. Let's look at VIX. Well, VIX is still concerning. If you look at both their moving averages are green, meaning they're sloping up. Anyway, but today's action in VIX, the price is coming down. It just has further to go, right? You can just look at the cross. I was looking at this the other night. So a bullish cross on the VIX is bearish for the market. So that would have been a sell the market at 601 signal, which is about where we're at now, but that would have been working out all right. So this one right here, a bearish cross on the VIX, is a buy the market. So the market was at 589. If you'd have bought the market at 589, then you would have sold it at 601. That trade would have worked out well. You caught a nice trend there. The VIX will eventually, both of these moving averages will turn red, and the price will get under the moving averages and it'll start going the other way. And when it does that, of course, that means the market's rallying, or the market will rally because of that, which came first, the chicken or the egg. I don't know. But right now, we are on watch to watch the VIX turn back from bearish to bullish. But let's look at VIX futures. They're a little bit faster. Well, they trade 24 hours, so the signals are faster. But you can see same thing here. They went on a sell signal at S&P 600, but then they had a buy signal right here that was after hours, so you couldn't have done anything about it, and then it's back to a sell signal. So they're still on a sell signal. But the bulls are wanting VIX to revert to its mean at 20 or 19 and a half, and if not lower. But that would be a good start for bulls, right? So we'll keep an eye on that. Let's look at VIX of VIX. This is kind of a smart money indicator, and it's even more bearish. So it's caution ahead, right? All right, caution ahead for sure. Especially if you're looking at the VIX. I mean, it's something's going on with the volatility, but it was somebody in the room. Could have been Mark. Yeah, it was you, Mark, and it was yesterday in the live stream. You made I'm trying to think what you said, but you had it figured out. All right, let's look at some other stuff. Let's check out the old model portfolio. How do you think the model portfolio is doing? I haven't checked it out today. I updated it last night, which means it may not work. Oh, it's working. All right. So that's not good, though. Why does it do that, though? I guess maybe that's right. Is everything really moving that much? I think this is jacked up though. I think this is how much each. Yeah, this is how much each stock's moving, not how much it's moving for me. Anyway, sorry, I was up too late and I got that jacked up. But that's how much each stock is up or down. And this is the average of each. So the average stock in the portfolio is up 1.5%, but I don't have even amounts of it. So this really doesn't tell us anything. Darn it, I don't know how I got on that. Anyway, that's more what I'm looking for, what the actual stocks are up for me. Anyway, I'm sorry it's jacked up. I was up too late. Anyway, I think suffice it to say, the model portfolio is doing well today. I don't have any AMD to speak of or any Coney, and they're the ones that are up the most. But I don't have any Misty, and they're the ones that are down the most. Really, I mean, I have 2% or something. All right. Well, anyway, I'll try to get that. I'll get that fixed before next time. All right. Premium collection. Let's see if this works. The answer on this one is partly my logic, where it tries to separate the synthetic from just the short premium, is kind of breaking down. This GPTY, these are all short premium trades right here. But they're more than a month away. Well, look at the 627, 620. Those are all, those are fine. Okay, now I'm sorry. The GPTY, no, those made it on there, and that makes sense. They sold $89,000 worth of short premium. I thought there was a couple of those that really were short premium, but they just missed the cutoff by a day or two. And anyway, I need to go back and correct it. Okay, so GPTY sold $90,000 worth of premium. Doesn't sound like a lot. LFGY sold $300,000 worth of premium. Let's see what LFGY's biggest trade was yesterday. GXLY. They're selling this GXLY, the 205s, and then they're going buying the 230s as part of a call spread. Then I'm sure they also own the synthetic somewhere. So great job, GLXY. I've looked that up once. I've already forgot what it is. Anyway, great job. Look at this one. Actually, this was their big trade of the day, MBTX. That's their hedge position. That's their micro Bitcoin. And they're actually, on this one, they're actually selling calls and then buying. I guess that's not their hedge. That's a bullish position. But they do have a hedge in here somewhere. Anyway, these are trades, not positions. I guess I would have to look at the positions. MBTXW is the hedge. Look at that. That's the put. They're selling the 150. They're buying the 230 put, and they're selling the 150 to help offset it. Okay. That's the hedge. The hedge is MBTXW. MBTX is just a normal bullish position. So they're long MBTX, but then they're using MBTXW for their hedge. Okay. Let's go up here and see what else we have. Soxy sold 15,000 biggies. Now here we go. Here's a man's fund right here. ULTY. This is what a man invests in, right? This isn't a ladies fund. GPTY, that's a ladies fund. This ULTY is a man's fund. Anyway, no, but look at this. Let's see what their biggest trades were. They just sold premium all over the board. I mean, they sold $300,000 on a APLD. They sold Coney or Coinbase premium, First Solar, LabU, which is leveraged biotechs. They're just selling premium everywhere. 2.25. Now that sounds like a good amount. We'll look at the proportion. I guess we'll look at the assets under management and see how much that really is in a second. Carvani, Mari, Palti. Is there any of these other ones that are interesting to us? Misty. Look at Misty selling $4.7 million worth of premium. These guys are selling the 397 and the 392 and the 395. They're selling everything they get. They sold some 400s also, and some more 397.50s, and some more 395s. These guys are just selling everything they can find. Great job, MicroStrategies. All right, so let's go over here to the let's check out the daily net premium report. Outside of that, well, I guess GPTY looked all right. I really didn't see too many. I saw one or two things on there, but let's look down here at GPTY. Okay, so just as far as, these things want to earn about a quarter point a day. That'd be 50%, or so anyway, you can, some days they earn less, like Carvani just earned 3 bips. SMCY just earned 1 bip. All right. So the big earners of the day were Murney and Morrow, earned more than half a point. ULTY, they earned 0.46. That's what I wanted to see. That 2.5 million came to about 0.5%. We darn sure take that every day, right? All right, what are you guys looking at? Yeah, I never. Okay, so let's talk for a second. I never knew about option about barrier options either. Now I've heard of. Yeah, I mean, I may have heard of them or something, but and then about every time I did some research and I asked Grok and I asked Claude and then then I did some research. I watched another influencer's video. I think I found a video from one of the companies where they were explaining it. Anyway, I thought I had it figured out, and I thought this is just a put spread. It's just a buffer. You don't start losing until you hit. But then about the time I started to think I have it figured out, I don't think I have it figured out. So I would love to get a better handle on barrier options. I don't really. There's only one out there that's doing it. It doesn't look that great. I mean, I think we have enough other choices to sell premium, but I would like to at least, be able to use barrier options for a tactic. Anyway, if you guys have a better understanding or watch that video and I said something wrong or something, by all means, correct me. Or some of you guys may have worked at a bank before. We had a guy in here, Jack something, he was a professional option trader for a living on Wall Street, and he would correct me lots of times on stuff or sometimes on stuff I said. Anyway, I don't think he's around anymore, but or would explain it better. Anyway, all right. Hey, Dan, thanks for being here. You have a little wrench next to your name. I think that's because I made you my moderator that one day, but I think that means you're just always moderator. So anytime you're in here, if for instance, if you see Mark and he's lipping off, you can just go ahead and put him in timeout, okay? I'm just joking. I should make Mark a moderator too, because Mark's in here all the time too. Anyway, all right, Dan. Hey, thanks for being here. Marcus, everyone, thanks for being here. Okay, so I wanted to answer a question from Summit. Is Summit here yet? Summit, if you're here, put your name in the comments. Summit listens behind, but he asked a question yesterday. He watched the video yesterday. And I rewatched my video and then I reread the comments and he had a question. Let's go look at that and try to get in the middle of that. Try to get in the middle of that question, see if I can answer it. See if I can answer it better. Because I kind of lipped off. I was kind of lipping off myself and contradicting myself. And Summit mentioned it, or it didn't mention I contradicted myself, but said, well, why can't they do it this way? Anyway, let's get in the middle of this. Let's see what I did. Let's see what kind of mental gymnastics I have to do to get myself out of this one. Okay, so how would I even check this out? Gosh darn it. It was on my iPad. Gosh darn it. Now you guys don't want to see my face. All right. God, I was up late last night. I woke up at 5 o'clock in the morning. I was up late, and then I got up at 4 and couldn't fall back to sleep. And tossed and turned until about 6 and finally fell back asleep. Okay, your videos. We're just going to look at my video and we're going to go to the comments. Anyways, a good question by Summit. Basically, what I was saying, I was trying to explain, and I've tried to explain this several times, that they they can't do a fund where they could call it return. I mean, I wish they could do a fund. I wish they could do a fund where they could sell options, spend half the options on leaps, half the premium on leaps, the other half the premium on puts, in the weekly time frame or something. And I guess they could do that. But what they can't do is it just doesn't work with the way these things are traded. They can't just leave a lot of cash on the balance sheet. I'm doing the worst job. Gosh darn it. I'm absolutely doing the worst job. Okay, where in the heck was this yesterday? I watched yesterday's video, and yesterday's video was a decent video. And this blocks, I mean, it took me a while to get into it, but blocks is interesting. And we're going to I also want to follow up on something from that video. Gosh darn it. No wonder I don't make any money. The freaking, I didn't even have monetization on. I don't turn on monetization half the time. It really doesn't matter. When you only get like 20, I'm getting 20 views a day. They don't really pay you for that. And that's fine. My station is now a niche station. But anyway, be that as it may. All right. Where's the darn comments? Okay, maybe I haven't responded because I tried to respond. Yeah, I responded. Okay, hey Max. Okay, hey Max. How can QILD, which is from Global X, sell 100% at the money options? They sell options that are right at the money, and they hold back and they only pay 1% a month. They make more like 2% a month, or 1.5%. It depends on the month, but yeah, they only pay 1%. Or they actually pay half. I've looked at it before. It looks like they actually pay half of what they make. They actually most months make a little bit more than 2%, and they'll pay 1%. There's some months where they only made 1.5%, and they'll pay 0.75%. I don't know if it says it in their prospectus, but when you go back and look at their pay history, that's what they do. It says, how can QILD hold back and pay only 1% a month? And YieldMax could not do that. Okay, because the point of my thing was I was trying to say, look, YieldMax can't make a fund like I would like. I want a fund that's return max. Like I say, I want to recycle the premium, because you guys don't like growth. I mean, or I want everything. I want everything. All right. So they could do that. But I think the point I was trying to make is if they had a strategy where they just held on to money because of the structure of an ETF, and the ETF provides daily liquidity and people want in and out. It's the daily liquidity and people wanting in and out that make it where they can't hold on to profits, because then people, I'm doing a terrible job explaining this. Anyway, let's see what Tony said. He said YieldMax is, Tony's saying what I'm trying to say, so maybe this will help me. YieldMax is designed to pay maximum yield and not hold any back. Although they must pay it back within the fiscal year. What you're talking about would be a prospectus change. Okay, I agree. Before they can legally change the strategy, that's not their objective. And I don't think that's what someone's talking about. Maybe that would require a prospectus change, but I think someone's just saying, QILD holds some money back. Why can't YieldMax? And I think YieldMax could hold a little bit of money back. But QILD is not holding back a lot of money. But I was trying to make the point, if somebody made a fund like I like, where they just focused on total return, because of the ETF structure, it won't work, because people would want out. And people that got out while the fund was holding money because of the ETF structure would get extra money that the people like me holding for long-term growth wouldn't get. And so then it just wouldn't work. You'd have to do it as a closed-end fund. I'm just saying you can't do a structure and give liquidity to everybody 24 hours a day, and hold much premium back. That was more my point. But anyway, but that gets to my question. But I still don't see, why couldn't they do exactly what I'm saying? I don't know why I haven't asked you this, but Why couldn't they have one of these funds, like the new lightning spread fund, for instance, that take the new lightning spread fund and just make it a growth fund? But anyway, speaking of lightning spread, let me show you guys something. I thought that, yeah, I know the wild video. Gosh darn it. Okay. I'll get that done for you. Hey, let me take this off the screen. I wanted to show you guys something cool. I was kind of trying to stall because I want Mark to be here. I think Mark might do something like this, but oh yeah. Anyway, okay. So check this out. So I was up late back testing. So look at this. I did a variation. Now, this isn't the goat spread. Maybe I should start calling this one the goat spread, but I did a variation of the lightning spread. I did daily lightning spread. So a lightning spread is selling a 50 delta put and buying a 40 delta put. That's the lightning spread overlay part of it. And I don't know those are the deltas, but that's as close as I can get Jay to tell me. He really can't talk too much about it, but it's going to be something like maybe 40 and 30, but it's going to be, or maybe 50 and 45. It's going to be a tight little spread there. But anyway, so all I did is I did the lightning spread, but instead of stock, I bought a deep in the money option to replicate stock. Actually, two of them. Okay, 280 deltas with 20 days to expiration. So that has your stock covered. It's like having double stock and selling lightning spread on half of it. So half the stock is totally unencumbered, doesn't even have a lightning spread on it. The lightning spread doesn't encumber it anyway, but most of the portfolio is unencumbered to grow and grow and grow and grow. This is I want it all. This is I want it all. And this is, look at this. You could do this. This is since the inception of the test, which goes back to 2013. This may beat the goat spread. I don't know. The goat spread is like this also, but I haven't run it in a while. But I mean, look at this freaking thing. Are you serious? I mean, it buy and hold 17,000. You know, this more than doubles buy and hold. I mean, and look at this, and it's at an all-time high, and it hit the all-time high way before the market did. And you ask yourself, why is that? Well, let's go look at the individual trades. Let's go see what you're doing on this thing. So look, these are the individual wins and losses. Look, that one win over there was $10,200. That was the day the market was up. If you have an in-the-money call option and you're, and the market's way up, you're doing good. Plus, you sold put options. You'll get the premium on that. I mean, this spread that Jay discovered is a win-win situation. You get the premium and you don't get some of the associated problems. But once again, this isn't really as much of this strategy that I made isn't really as much of a premium collection strategy as a growth strategy. But I just thought somebody like Mark might be interested because Mark, you have SPY. You could do the same thing with SPY shares. You could own SPY shares and sell the 50 delta put and buy the 40 delta put and do that every day. It won't mess with your SPY shares, and it's an extra amount of income you can get. You know, you're still long. You still want the market to go up. If the market goes up, that's fine. But anyway, I really like those kinds of trades because that trade is a long volatility trade, but it's not long the kind of volatility in a crash, but it's long the good volatility. It's long bullish volatility, because because you don't have any call spreads. You don't even have any covered call spread. Even the covered call spread impedes the upside a little bit. You're capped between the two strikes. This freaking selling the put, I can't believe I didn't think of that. Combining a put spread with some type of long stock structure. It's a genius idea. And you can do the opposite. It just doesn't test as well because stocks usually go up, but you could also do the opposite. But anyway, I thought that was a good back test. But look at these logs here. So here's actually what you're doing. You can see actually here's every day what you're doing. It cost you $328 the very first day to put on. But you made $46. That's nice. The next day you spent $300. You do this every day. You spent $364. But you made 191. That's not bad. These are debit spread. It's not. It's a debit because it's a long story, but Tasty Trade doesn't let you keep one position on for a month and sell 30 times against it. So I'm just simulating putting the whole thing on and off every day, but you could do that also. I mean, especially with results, there's no commission. With results like this, I mean, I actually tested leaving it on for 5 days at a time, and it doesn't do as well. The zero DTE is what's killing this. A fund manager needs to come out with this fund, right? They need to bring this fund out where they have 2 synthetics, so they have double upside, and they sell 1 lightning spread against it. Great plan. Great freaking plan. But anyway, okay, so let's go. Let me show you how it made $10,000 in one day. Well, let's see how it did around 2020 also. We can see how, we'll check that out too. So we know what to expect if we get in a bad market, which we'll have one. But I'm excited about these lightning spreads, especially the ones in the daily time frame. Okay, so look at right around 2020. Let's see what happened. All right, here's Feb of 2020. Now you see the premium, what it's costing you to get in is more expensive as volatility goes up. By February 3rd, it cost $1,200. A couple of weeks before, it was half that much. And a couple of weeks after, it was a little bit less also. But then in March, it really went up. In March, you had to pay $2,000 or $3,000 each day. But some of those days, you made really good money. In April, on the other side, coming back up, you start killing it again because it is a bullish strategy. But anyway, okay, so let's go to current day. How much do you think this would have made on election night? Or the biggest update in recent history has been the tariffs getting canceled. That was that 10% or something. Okay, so and here we have that. That right there is 4.8. So the trade you put on, it cost you $5,700 to put that trade on. Granted, I mean it's not cheap. I mean, but you're long 200 shares of the SPY, right? I mean, because you have 280 delta. It actually with 280 deltas, you're long about 150 shares of the SPY. Okay, and so that you could even call this leverage. It should get extra upside. This is the perfect fund, or the funds need to start coming out like this, where they try to actually add alpha. These types of strategies have the chance to add alpha, I think. So we'll see. What do you guys think? You guys are sharp traders. At least Mark is. Mark, what do you think? You may try on your cash against. Yeah, it's just one other thing to try. I'm looking. So the way I did it, look at this. Let's look at this. Let's do it in Taiwan semi. Let's do it in trying to think, let's make it smaller, or let's see how much money you tied up. So $48,000 total profit loss, and it was tying up $5,700. Because all you're doing is buying a couple of, I mean, you guys get it. I mean, anyway. All right, so let's do this. Here's a little bit of a less crazy way to do this, but this way works out too. This would be more probably the way I would do it, but that single day back test is so good. But you really just do this every 5 days, right? Do it on Monday and let it go to Friday. Just sell you some puts, whatever. Or you're a big time trader. You do multiple tranches of this. If it's only tying up $5,000. Depending on what size accounts you have, do 5 tranches. If you have $25,000 invested in this type of strategy. Anyway, so let's see if we did it like that, what would happen. And let's not go the all available data. Let's just go the past 2 years. Or let's go the past 5 years. It won't take that long to run. The other thing, on a covered call, program. People, you hear people all the time say, well, I'll just sell cover calls myself. I won't have any erosion. Screw that. I'm not going to have any erosion. I just sell them myself. Well, no, you're still going to have erosion's just the losing trade. What people are calling erosion generally is trades that lose. Market goes down and you lose, the reason you don't think you have erosion, if let's say me and Mark, we're going to make a partnership. We're going to start trading covered calls. I'm going to give Mark some money and we're going to start trading covered calls together. Well, Mark and I would have an agreement that I can't get my money out anytime I want. Mark's not an ETF. All right. So Mark would do it like a trader. He would sell covered calls whenever it was good to, and he'd keep some of the money in the account. Then occasionally, if we had a good month, he might pay a dividend. That's how two guys would do it. And so they would only pay themselves when they had a good month, and they say, look, no erosion. It's not that there's no erosion. It's just that when you're trading it yourself, you realize not every trade's a winner. You can't pay yourself all that. When you're, but in these ETFs, they have to offer 24-hour liquidity, which is one of the good things about them too. That's one of the things that makes them attractive. Anyway, but if you're just trading it yourself, you don't have the erosion problem. Just imagine like this. Imagine this. You're trading covered calls yourself and you're giving your wife an allowance and you're giving her $500 a day or something to maintain the mortgage out, Okay. So you have a bad month selling covered calls. She still gets your $500 a day. All of a sudden your capital is, down from 100,000 to 75,000. You're down 25% on that. That's what people are calling erosion. It's just the fund had a bad month. And the ETF has to offer continuous liquidity. The ETF is like somebody that's promised the money to their wife. It has to have continuous liquidity. So is that a better? I think maybe I did better with that answer. We'll see though. Anyway, probably the guys that are here listening are the ones that already understand this, but maybe there's somebody watching or something. I don't know. All right. So look at this. Anytime you can beat buy and hold. I do strategies all the time, and very rarely does strategy beat buy and hold. This one's spanking buy and hold. Just throttling buy and hold. Now it has a higher drawdown. Of course, you wouldn't want to. These income strategies generally do have higher drawdowns. You wouldn't want to do it with your, your whole account, obviously. But this is like I was saying, you break off a portion of this. Maybe you do it once that you could do daily tranches. Let's see if we can make it better. So we average $94 a trade, but let's do it this way. Let's do 5 trades a week. Let's do 1 trade a day in tranches. It's going to cost a little bit more money, but it'll smooth out our results. And this is more the way that a real person would do it too. That you're going to do it, But pretty much you should just have the market results. If the market does well, you should do well. You don't have, it's because you're just long options and selling some premium against them. Sorry, this is kind of slow. This is the last back test I run, but it's just one of many, many tools to look at. A year ago, we didn't have the tool of, a year ago, the only thing that people knew about was covered calls. The covered call spread was just barely invented 6 months ago, or maybe it's been a year now. But we're coming a long way in option technology. So this was a little bit less average profit per trade, but it probably smoothed out the results. But also, that other one was just tying up $5,000 if you wanted to use more money, if you're trying to make more of an income. This one ties up $35,000, but it averaged $68 a day income, and that's after expenses and stuff. So, and that's every day. That's not bad. It's not bad on that small of an account, and you still get the unlimited upside. If you guys listen to my Twitter Spaces yesterday, that Brad, Income Architect, I finally met somebody that's as into upside as I am. He's obsessed with upside, and I've watched his channel a few times. I just didn't pick up on his channel how much that he was obsessed with growth and with upside, and I am too. I love these covered calls and stuff. My only wish is I want to do them but I don't want to do them so much I mess up my retirement. I want to do them just enough that I need to. Same thing that my grandfather did. Same thing my dad's doing now. You just, it's their income strategies for retirement. But like I say, my grandfather and my dad would get up and read the Wall Street Journal. This is the New York Times, and go through the pages, and you're looking at yesterday's prices, and you're going, yeah, I think I want to sell let's see here. We're going to sell maybe the 65 call. They didn't have very many strikes. You might have a 65 strike, a 75 strike. They wouldn't have very many expirations, quarterly expirations, probably. It was, but they still did fine. You could still, and even with paying commissions and stuff, covered calls since the beginning of time have been a way that people with stock have turned some of their stock into income. I always give the example of Warren Buffett, but anyway, and that's why I like meeting you guys, because it looks like a lot of you guys are probably my age, maybe 40s, 50s, getting closer to retirement, where you're starting to think about needing a little income with your growth, right? The idea is that presumably by the time you've reached your 40s or 50s, you've had some growth. I mean, and that's the idea. All right, Marcus, what are you saying? What's cheaper to do? Trading options yourself, just buying ETF combos? Yeah. SPUT and XD. For less, I just like things that are easy. So I would say just doing it. I like the way I do it. Just pick a portfolio of 5 or 6 of them, a few long ones and a few short ones, and just try to stay balanced, just like a hedge fund would. I'm trying to make mine like an endowment. I want that fund to last forever. If the market goes down, it's fine, because we'll buy bearish stuff. Market goes up, it's just gonna. That's my idea. Is I want these funds to last forever. Well, anyway, yes, doing it yourself is fun, and I like to do it myself. But covered calls aren't the most fun thing to do yourself. So I think it's a better strategy to let these guys do. You aren't going to do it. Let these guys do the covered call, and then save your money. What's really fun to do is to sit in here when the market pulls back and to take a shot, buying some stuff here and there, or putting on a butterfly, or putting on a ratio diagonal or something. I like to do those types of trades with my own money. But when these, I just don't think I could sell options more consistently and better than JP Morgan could at JEPQ. I've often said if I had to put all my money in any one fund, it'd probably be JEPQ, JEPI or something. But the good thing is we don't have to put all our money in one fund. I will say this, but if you're a good trader, Marcus, you could probably save and do it yourself. There's people out there that I would say should do it themselves, like Mark's doing it himself. It just depends, but it just depends. Like I was saying on that live stream yesterday, I thought my whole life I was going to sell covered calls when I got older, because that's, I figured I might have a little bit of stock and I would just sell covered calls. But like I say, then they invented these, and you really don't need to. You still can, but what I'm trying to do is using my knowledge that I've gained from talking with Jay and on this channel to do more sophisticated trades myself. But let them sell the covered calls. Covered calls are great. All right, so let's see what you guys are saying. That's okay. That's true, Max. For example, I sold covered calls. I sold yesterday. Expired day are currently underwater. So unless the market turns around before the end of the day, I'll end up rolling them up and out. And right now, all the profit from the covered calls goes to buying down margin. Okay, well, Mark, so you're agreeing with what I said, or you're understanding what I said. Yeah, when you're doing a program like that yourself, you don't have to give daily liquidity to anybody. So that's the daily liquidity. Just that feature is what causes what most people are confusing. Oh, the erosion's so bad. The erosion's so bad. I remember when I first got in this, the erosion was so bad on Tesla. Oh yeah, that Tesla erosion was something else. And now it's the Murney erosion. Well, as you guys know, it's just the stock. Tesla was a bad stock. Moderna is a bad stock. At some point in the future, there'll be good stocks, but I would say, Marcus, I'll keep thinking about your question. I would say just let the pros do it. That's what that's what I do. And then I like I say, and I'm still going to trade options, but I'm just going to try to do it in as little of amount as possible, so I don't mess up any of the growth that I've got over the years or any of the good work the pros have done. All right, so what's Mark saying to Marcus? Unless you can watch the market all day, you're better off on ETS. Yeah, but there are some people that watch the market every day, and that's what they do. And so I don't really think there's a right or wrong answer to that. All right, did we cover everything? Is there anything going on? Let's see. Let's go to option strat and see if anything in there looks anything we need to talk about. All right. This Melly trade's looking good. It wasn't really a trade. It was one of the funds put it in. Market hedge for 2 weeks plus income. Now, this one, I did it June 4th. I did it before we knew that the volatility was going to go up. I was trying to show it to somebody. I was showing hedges or something. But so this one, you're long UVXY, which is volatility. But you guys get the idea. You're selling puts to buy calls. You get a premium in the middle. This is getting ready to expire. The 20th is 2 days, so it expires. So we need to put on a new one of these. That's going to be the morning show trade of the day. Is I'm going to show you guys how to do these. These are handy ways to hedge. We can do it in UVIX this time. I know some of you guys like UVIX. It doesn't matter, I don't think. Let's just sit in here, and we're trying to get some cheap protection and get paid while we're protected. So this would make us long volatility. So if the market would have melted down, we would have done well. But the market hasn't melted down. But when VIX is low, you can hedge. The thing that people like Jay will tell you, and when I listen to interviews, that when VIX is low, they'll hedge with VIX, and when VIX is higher, they hedge with S&P puts. Or they use other things. But with volatility being so low, especially like it was 2 weeks ago, it can make a decent time to add some protection by just buying volatility directly. So you aren't betting on the market to go down. It's just that when the market does go down, volatility traditionally increases. So let's see. Some of these aren't the most liquid and don't really work. UVXY is pretty liquid though, so that's not bad. It's not bad. And then let me adjust this a little bit more. All right. Well, that's the rollout of that other trade. That other trade's going to make $100. But anyway. That just goes out to the 27th. So that gives us protection. So that would be good for somebody that's doing covered calls or whatever. You have one of those on. And then all of a sudden we do get a 2 standard deviation move in volatility. Hope it doesn't happen, but it does happen 2% of the time or something. Then you have some extra money out here to offset some of your other some of the things that you're writing premium and stuff. Anyway, all right. So that looks like that's all we got to talk about. Model portfolio. I was just trying to see if there's anything else. I guess let's look one more time at the charts. I'll let you go. It's 10 o'clock, so it's about perfect half hour. I came on a little bit late, so it's about perfect 20 minutes. Now look at this. Markets always go up, right? Buy every dip. Markets rallying, looking good. The only somewhat concerning thing I can say, look at the market and then look at Bitcoin. If you go by the theory that Bitcoin leads, maybe the market is going to pull back. But if you go by the theory that the market's leading, it's time to buy Bitcoin. Surely we make a new high. Surely we won't get this close to a high and not at least make one and then trap people before we go down. So we'll see, though. That's kind of what I'm thinking. All right, Mark, what are you saying? You're up. Yeah, nice job. You're killing it. It doesn't surprise me. Covered calls are, I mean, you're selling, SPY is a big product and you're selling 4 contracts at a time. I'm surprised you aren't up more. I mean, but you're doing great. That's kick ass. Kick ass. Anyway, all right, guys, I'm going to get out of here. I'll be back at the end of the day. How about that? I will shoot for 230, 240, something like that. Okay. All right. See ya.